Hello there and welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there is a place for everyone on our show. I'm Archie Chinarker and I'm your host. Today we're going to be discussing financial statements, and today's episode is going to tie together some of our previous episodes. Now, before we had discussed debit and credit and identifying what types of accounts were debit and credit accounts. But really, what we talked about then were some pretty small and narrow examples. Well, today we're going to zoom out and see why debit and credit are important and how understanding those two can help you. And the field that they are related to is fundamental analysis. A lot of fundamental analysis is going through financial statements. And by going through lots of financial statements and annual reports, you're able to get a good read on a company. You're able to figure out what its earnings are, what its earnings are projected to be, and what its debt to equity is, things like that. And so today's episode then is tying together our debit and credit episodes as well as our fundamental analysis episode and seeing how those two subjects relate to each other. So let's take a look at some types of financial statements. Now, this is not a fully comprehensive list, but the three types of financial statements that we're going to be discussing today are the balance sheet, the income statement, and the cash flow statement. If you go to analyze a company or look at its annual report, these three statements are the three financial statements that you'll end up seeing most often. So it's good that you know what they are and how they work. Okay, let's look at a balance sheet first. Now let's think back to our dealer acronym that we first learned when we discussed debit and credit accounts. A quick reminder, the way we differentiate between debit and credit accounts is we split the word dealer into two equal halves. We draw a line between the A and the L. The first three letters in dealer are your debit accounts. Those are dividends, expenses, and assets. The right side of the word stands for liabilities, equity, and revenue. Those three are all credit accounts. Now, when we talk about a balance sheet involves three parts of dealer. It involves the asset account, which is on the debit side, and on the credit side, it involves the liabilities and equity accounts. And why those three accounts are important and why they're used in a balance sheet is because the value of all the assets that a company has is equal to the liabilities plus the equities. Now, the way I remember this is I remember that the word balance is present in balance sheet. Balance sheets have the word balance in them, and therefore they're a balance between the total assets and the sum of the liabilities and the equities. And that's what a balance sheet is showing you. It's showing you A, the assets from the debit side, and the fact that the total assets will be some number. And then B, it'll show you all the liabilities and equities that a company has. And the sum of the liabilities and the equities is going to always be that same number as the total assets. Now, to see all of these statements in action, we're going to be taking a look at Disney's financial statements. And all of this information is publicly available. I went over to Disney's website and I was able to get this information from their 2019 annual report. So let's look at some of Disney's assets. They have $5 billion in cash and $15 billion in receivables. We talked about receivables when discussing debit and credit before. Receivables refer to money that other companies owe to Disney. From their resorts and land, they have about $60 billion worth of assets. And they have lots of other assets for a grand total of $193.9 billion. Now remember that number, $193.9 billion. The sum of the liabilities and the equities from the credit side should also be equal to $193.9 billion. Now let's go over to the credit side and take a look at their liabilities and equity. So in accounts payable, they have $17 billion. That is money that they owe to somebody else. They've borrowed some other money for a total of roughly $100 billion worth of liabilities. Now let's take a look at their equity. The value of their common stock is $53 billion. They have $42 billion in retained earnings, and they have some losses, so their total equity is equal to roughly $93 billion. That means that the sum of their equity and their total liabilities is $93 billion plus $100 billion, which is equal to $193 billion. That is the same number as the total amount of assets they have, and that is what a balance sheet shows us. All balance sheets should have their assets equal to the sum of liabilities plus equities. Assets equals liabilities plus equities is the most basic equation in accounting. Now let's take a look at income statements and go back to dealer. Income statements involve two other parts of dealer. On the debit side, they deal with expenses, and on the credit side, they deal with revenue. And income statements fundamentally show us the relationship between expenses and revenue. So going to Disney's income statement. They had total revenues in 2019 of $69.5 billion. Now they had quite a few expenses. So from that $69.5 billion, they keep subtracting their various expenses. Things like the cost of services, products, or selling general and administrative expenses. And all of their revenue, minus all these expenses, ends up coming out to about $11 billion. So this income statement shows us that in 2019, Disney brought in $11 billion in income. Now let's take a look at cash flow statements. Cash flow statements tell us as the reader, or as the shareholder, how money is coming in and how it's being distributed. So let's apply that to Disney. Here they have it broken down into several categories. They had $4.1 billion in cash from 2018, and their net income from 2018 happened to be $10.9 billion. So they got that 2018 net income of $10.9 billion, and in 2019, they spent it on various things like film and television costs and investing in the resort equipment. Going over to their financing, we see that they then borrowed $42 billion, but they paid back $38 billion of previous debt, and they also spent some money on things like dividends. And so by the end of the 2019 fiscal year, Disney ended up with $5.4 billion in cash. Okay, let's recap. There are three types of financial statements. There are balance sheets, there are income statements, and there are cash flow statements. Balance sheets always show you the assets, the liabilities, and the equities. And the total assets are always going to be equal to the sum of the liabilities and equity. And income statements show you the company's revenue minus the expenses. This tells the reader how much net income a company has. And cash flow statements, finally, indicate how much cash a company brings in each year, and then how they allocate or spend that cash. Now, initially when you go to look at these statements and reports, you may find it to be quite confusing, but over time you start to see patterns, and then you get used to it. So if you decide to go look at a company's annual report and are a little confused at first, don't worry. It's bound to be confusing initially, but over time you'll learn and you'll start to get better at it. I hope you enjoyed that episode and were able to learn something from it. If you're looking for recommendations for good investing and business books, I encourage you to check out the Project Business Basics blog and also sign up for the Project Business Basics newsletter. You can do all this through the Project Business Basics website, which is www.businessbasics.online. Also, make sure to check out our social media. We're on Instagram and Twitter with the username at PROJBIZ If you enjoyed the video, then please like and subscribe to our channel for more content. I'm Archit Janarkar. This is Project Business Basics. Thanks for listening,